Welcome back to Optimizing Cash Flow, our series of short videos to help small business owners make their cash flow in the right direction. My name is David Worrell from Fuse Financial Partners, and today we're going over our part number 4, the metrics of cash flow. We're going to teach you a little bit of math today. I'm sorry, I hope you're ready for that. It won't be tough, there's no quiz, but we're going to show you a couple of ratios that you need to determine where your company is at from a balance sheet perspective on the cash flow scale. So let's get right to it. We're going to go over a couple of debt ratios. And so I've got the math on the board here. The first one I want you to do is called total liabilities over total assets. And for that, you're going to need your balance sheet. Go down the right side of your balance sheet until you see the line for total liabilities. Divide that by the next number, which is total assets, and you'll get a ratio. Okay? You can express it as a decimal or a percentage, but 40% or 0.4 is about the highest that ratio should ever go. And of course, the lower, the better. You really want less liabilities and more assets. So don't let your liabilities over assets ratio get above 0.4. If you see that it's up there, maybe it's surpassed 0.4, start to consider refinancing debt, paying off your loans a little more quickly, liquidating some assets in order to pay debt. Anything that you have to do to keep that ratio under control is going to be very helpful for your cash flow in the long term. There's one other that you should look at, and that is total debt service over income. Now, I can't give you a hard, fast rule for what this number should be. It's a little bit different for every business, but in general, we're talking about the cash that you send to pay off a loan each month over the total amount of income you make each month. I'm going to tell you maybe 20% is the most that number should ever be. Again, it's different for every business, but calculate how much money you send to your credit cards, your bank loans, your car loans, whatever it might be, divide by the total income during that same period and start to track that number. Keep it as low as possible. Finally, what I wanted to talk about is tracking those numbers over the long term and seeing the trend. So as you measure these things, write them down. You know, I have a great story about the giant piece of newsprint I used to hang on the back of my door in my office. And each week or each month, I would measure these things. I'd measure accounts payable and accounts receivable and liabilities over assets and total debt service and all those things. And I would plot them using a handful of crayons and markers. I'd plot each week where those ratios stood so that I could begin to see the trend lines. And you always want to set a goal and make sure those trend lines are going towards your goal. Otherwise, you need to take some action. So I hope that's helpful. It's a little bit of math that'll tell you what's going on inside your company. Join us for the next segment of Optimizing Cash Flow. I'm David Worrell from Fuse Financial Partners. Thanks for watching.